Alrighty. So in today's video, we are going to be talking about the Iron Condor assignment reversal strategy. So getting assigned is one of the scariest things that many people face, right? They're afraid of getting assigned. And what's more scary is that if you get a margin call, right? So a lot of people, when they trade the Iron Condor, and all of a sudden they get assigned, they have no idea what to do, and they really panic. So if this is you, you have no idea how to unwind an assignment, then do not worry, have no fear, because I got you covered in this video. I'm going to share with you a very simple way to unwind any Iron Condor assignment that you have. All right, so let's dive right in. So first of all, when are you most likely to get assigned on your Iron Condor? Well, the answer is that when either of your short legs goes in the money, right? So one of the things that you need to understand is that you can only get assigned on either the put side or the call side, right? There's no way for you to get assigned at both places at one time, right? Because the market can only be at one place at any given time. So it's either you get assigned on your short call on your Iron Condor or on the short put. Right, so the time when you have the highest risk of getting assigned is when the extrinsic value of the short leg is very little, right? And that's usually when there's not many DTE left and when your short leg is deep in the money, right? So when your short leg is really deep in the money, right? Let's say, for example, for the call side, basically the market has just blown through your call spread, or on the put side, the market has gone way past your put spread. So this is time where your short put strike and your short call strike is going to be very deep in the money, right? So deep in the money, this is when you're going to have very little extrinsic value and a lot of intrinsic value. So another thing that you want to take note is that for the call spread and the put spread side, there's a slight difference, right? The slight difference is that for the bear call spread side, which is this call spread up here, basically for the call spread, you have an additional risk, which is what we call the dividend risk, right? Dividend risk is basically when the underlying that you're trading, be it an individual stock or an index ETF, is going to pay out a dividend. So this is a time where you want to take a look at the dividend paid as well. So the time when you're going to have the highest risk of actually getting assigned on your short call strike is when the extrinsic value, all right, let me just write it down here. Your extrinsic value is lesser than the dividend that is going to be paid out, right? So let's say, for example, if your extrinsic value left on this short call, let's say it's about 30 cents, okay? So let's say it's 30 cents. This is a dollar sign, by the way, on the left-hand side. It's less than the dividend. Maybe the dividend is paying out 50 cents, right? So during this time, you could have some dividend risk because the buyer of this call option right now, remember now you are short the call option. So on the opposite side of the trade is the person will be buying this call option. So the call buyer has the option to actually exercise his call option. And when he exercises his call option, he's basically going to be long 100 shares. So if this call option buyer, he was to sell off his call option, just sell it off without actually exercising, he would only get 30 cents. But if he was to exercise it and then actually get the dividend, when the dividend gets paid out, he's going to get 50 cents. So there's more incentive for him to exercise. So this is very important for you to really take note of if you have any short call option that is in the money and the underlying actually pays a dividend. Now on the bull put spread side, which is basically just the put spread, there is no dividend risk, right? There's no dividend risk, so you do not have to worry about it at all. So even though if the market, goes way below your put strike, you don't have to worry about the dividend, right? It does not affect it at all. And the reason why it doesn't affect it at all is because on the opposite side, the person is actually holding on to a long put. So with a long put option, if he exercises it, he will actually be selling 100 shares. So if he's selling 100 shares, he does not get any dividend. The only time you will get a dividend is if that person actually owns the shares. All right, so that is why there's no dividend risk for the put spread side. Okay, so let's talk about the put spread side first. So what happens when you're assigned on your short put leg? So basically, when you assign on your short put leg, you will now be long 100 shares at the strike price, right? So let's say, for example, the strike price is $100. So what this means is now you'll be long 100 shares at $100. So the total capital you have to put up for this would be $10,000, right? So if you do not have $10,000, then this is where you could get a margin call, right? So $10,000, most brokers would want you to put up 50% of it, right? So if you're on a margin account, by the way, if it's a margin account, you have 50% margin by default. So you only have to put up $5,000 for that. And if you do not have this $5,000 in your account, then you're most likely going to get a margin call. So at this point, what do you do? Right, so some people have mentioned that all you have to do to unwind this, all you have to do is to just exercise this long put option. Because if you exercise this long put option, what's going to happen is that it's going to sell away this 100 shares that you have. So this way you have no more positions on the bottom side, right? But the problem with this is that you are actually going to realize the maximum loss of this spread down here. Because don't forget, when you are exercising this put option, what you're doing is that you're telling the broker that you want to sell 100 shares at this strike price down here. So if you bought 100 shares at this strike price, let's say for example this is $100, the strike price, and then let's say down here is $90. So what's going to happen is that you are going to buy at $100 and you sell at $90, and you have just realized the full loss down here just to clear out your shares. Now, this is not an optimal way to do this, because if you were to just close out this position by itself, that means you were to sell off the 100 shares and then you were to sell this put option, you're actually going to lose lesser. The reason you're going to lose lesser is because this put option at the bottom down here, this long put option, still have some extrinsic value. And when there's extrinsic value left, it's going to help you actually cushion the loss of what you're making on this 100 shares. So you're actually better off if you just close out this position rather than exercising the put option, right? But this is still not the best way to do things, right? Because if you were to do it this way, what happened is that now you're suddenly no longer having an Iron Condor, right? All you have is just a call spread on. And if the market suddenly shoots back up, now your call spread is going to be in a risk. So what should you do instead? So here is 3 very simple steps to unwind your assignment, right? So the very first thing you want to do is to just sell off this 100 shares. Once you sold off this 100 shares, you're not going to have any positions. So it's just going to leave you with this long put option at the bottom. After that, all you have to do is sell the original short put strike. So again, if this short put strike is at $100, when you sell the short put strike, you're going to sell the same place as well, right? And you're going to sell the same DTE as well. So let's say, for example, maybe this has 10 DTE. So you're going to sell the 10 DTE as well. And the reason we want to do this is we want to do this step by step, right? Because if you plan to actually roll it and you roll it to maybe the 30 DTEs, then what's going to happen is that your short put strike is going to be 30 DTE, and now you're going to have a long put below that's 10 DTE, and the call spread is going to be 10 DTE as well. And it's going to be very confusing. So we want to do this step by step, very mechanical approach. So step 3 actually is just step 1 and 2 done together. So if you think about it, it's really just one step. So what it means is that if you get assigned, what you want to do is try and do it in a single order ticket if you can, right? Most brokers have this functionality. So you can see down here, you can sell off this put option and then sell the 100 shares at the same time, and then you will get back your credit. And what's going to happen is going to also relieve your margin call. So what do you do after unwinding your assignment?
By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video.
You're not out of the woods yet, because remember, this short put down here is back to the original DTE. So let's say, for example, it was 10 DTE, which means to say that this 10 DTE has a chance of getting early assigned again, because it was early assigned before, and right now you still have pretty much the same position, so it could get early assigned again. So now some people may just want to hold on to the spread and see maybe the market can go back up. Yes, you can do that, but just be aware that you could be early assigned again, and you have to do this whole 3 steps all over again, or rather just this one step down here, step 3. So what can you do instead of this to avoid this early assignment? Well, there are 2 options. Well, the first option, a very simple one, is to just simply close out for a loss that is lesser than a max loss, right? It's better than if you were to exercise this put option when you had the long 100 shares, right? So just close out for a loss and then wait for another opportunity. Remember, there is no need to win every single trade, right? As long as you put on the Iron Condor with the right mechanics, over time you should be able to be profitable. Now, what about option number 2, right? Option number 2 is if you still want to hold on to this Iron Condor and you think that the market has a possibility of it coming back up. Now, if this is the case, then option 2, you can go with this. Basically, what it is to roll your put option. First of all, you want to roll your put option to a further DTE. So let's say, for example, it's at 10 DTE. And then to roll to a further one, let's say you roll to the next 45 DTE. Okay. So when you roll this to 45 DTE, it's likely that you're going to roll for a debit, right? So this is going to be for a debit. So let me write the word down here, debit, DBT. So this will be for a debit because your price, the market, is actually in the money. So most of the time, the in the money put spread, if you were to roll out, is actually going to be for a debit instead of a credit, unless this price right now, this market price is somewhere near where the short put is. So a general rule of thumb, if the market is nearer to the short put strike, then you can roll for a credit. But if it's closer to your long put strike, and if it's way past your long put strike, basically below your long put strike, then it's going to be for a debit. Now, once you have done this, the next thing you want to do is to deal with the call spread side, because right now the call spread side, you can actually roll down and out. When you roll down and out, you actually get credit, and this can actually offset whatever debit that you have when you are rolling the put spread. So overall, you could actually still get a credit for doing this. So by the way, if you're not sure how to roll an Iron Condor, I actually have a video on rolling that. Just go to my channel and then look for that video. All right. So these are the two options that you can do after unwinding your assignment. All right, so now let's get into the call spread side. So what happens when you're assigned on your short call leg? So this is the opposite of the short put. So if you're assigned on your short put, you get long 100 shares. But if you get assigned on your short call, what happens is now you'll be short 100 shares at the short call leg strike price. So when you look at your positions, suddenly you won't see an Iron Condor, but rather you will see this position down here. You will see that you have short 100 shares at whatever the strike price is. All right, let's say maybe this strike price down here is at $120. So what happens is that when you short your shares, you again have to put up margin, and this is where you could get a margin call if you don't have sufficient funds to short the 100 shares. So in this case, what do you do? So again, people have mentioned all you have to do is just exercise this call option. But again, as you already know by now, if you were to exercise this call option, it just means that you're going to take the max loss of this width, which you have no reason to, right? There's no reason for you to go and take the max loss of this call option. So instead, we also want to use the same 3 steps. So in this case, the 3 steps will be this. So first of all, you buy back the 100 shares. Right? When you buy back the 100 shares, you have no positions. Now you want to sell the original short call strike price again at the same strike price and at the same DTE, just to re-establish the same Iron Condor which you have first initiated, right? Now step 3 is basically the same as step 1 and step 2, right? You put these 2 steps together, you do it in a single order ticket, and you will be able to get this, right? So this way, again, no legging risk. All right, so what do you do after you have unwinded your assignment? Again, same thing as the put side, you are still not out of the woods, right? You could get early assigned on your short call again, and that's not what we want. So similarly, there are 2 options, right? The first option is to simply just close out the spread for a loss and then wait for another opportunity. The second option is if you still feel that, you want to hold on to this Iron Condor and you think that the market can actually just retrace back down into your profit zone, then what you could do is this. So first of all, you roll the entire call spread out to a further DTE. So the same thing as what we did with the put spread side assignment. So you roll out to a further DTE, and then for your put spread side, same thing. What you want to do is you want to roll it up this time closer to the market and then roll out to a further DTE as well. And basically the DTE for the call spread and the put spread, you now want it to be the same. So this way, now you have a longer dated Iron Condor, although now you will have a slightly tighter max profit zone, right? Let's say, for example, if you were to roll to this point down here, so maybe previously it was 100, you roll the put spread up, maybe now it's 110. So now you have a slightly tighter Iron Condor, but what you have done is that you have actually extended the life of this Iron Condor, right, in hopes that if the market comes back down, you can still profit from this Iron Condor. Now let's talk about how to reduce the risk of early assignment. So although now you already know how to reverse any assignments that you have, well, as the saying goes, prevention is always better than cure, right? It's best to avoid any assignment in the first place. So how do you do that? Well, the very first method, right, would just simply be to exit at 21 DTE when either of your short legs is in the money. And we only want to do that, right, when it's around 21 DTE. So let's say, for example, your short call strike has been breached, but there's still like 30 DTEs on it. So at this point, do you exit? No, you don't have to exit because the chances of you getting early assigned is not that high, right? Unless, of course, your call strike is really deep in the money and also maybe the underlying is paying out a dividend where the dividend is more than the extrinsic value, then yes, right, you can consider actually just exiting the whole spread so you don't get assigned. But for the most part, the chances of you getting assigned is going to be low, especially also if you're going to trade the index ETFs. On top of that, if you were to exit at 21 DTE, you can see that the performance is actually much more superior than if you were to hold to expiration. So just from this graph alone, you can see that there's no need for you to actually hold all the way to expiration, right? So this is a study done by the Tasty Trade team, and I've shown this many times before in my other videos. So it should be drilled into you right now that, you know, if you want things to be safe, you want to have a superior performance, you don't want to get any early assignment, then just exit at 21 DTE, keep things very simple. Now the next would be just to trade the cash settled index options, right? So cash settled index options are basically European style options. European style options are options where there is no chance of early assignment. That means the buyer of the long options can only exercise during expiration. So in this case, there's no risk of early assignment. You can just trade this index options, cash settled index options, and there are a few, right? You have the SPX, XSP, NDX, the RUD, MRUD, OEX, and so on and so forth. Okay, so this is the Iron Condor assignment reversal strategy. So there's no need for you to panic anymore, no need to get nervous, even though, you know, any of your short strikes are in the money, because now, even though if you are assigned, you now know how to unwind any assignment that you have.
By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen and you'll be able to get it for free. Alright, I will see you in the next video.